Welcome to Keep What You Earn, your judgment and jargon-free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So if you listen to this show, by now you can probably appreciate the importance and the value of solid tax strategy. But we tend to gloss over a bunch of different strategies here. I try my best to condense as much as I can into these short, 5-10 minute episodes on particular strategies. But I wanted to actually dedicate a whole episode to one particular strategy that is crushing over in the real estate space right now, and that is cost segregation. This is a complex term with a lot of simple steps involved in it in order to save you a ton in taxes if you own real estate. Specifically, if you own commercial real estate, this is huge. So I'm going to welcome onto the show today, Sean Lichterman. Now, Sean is the owner of CSSI. He specifically has an entire practice dedicated to cost segregation. This is actually brilliant for two reasons. Number one is he's an expert in this area and has done it himself several times. And he's going to tell you all about the client success stories. But also, this is a great example of how he has niched down so specifically into one particular strategy that he is lather, rinsing, and repeating over and over and over again for different clients. Imagine how good a musician plays a song they've played over and over and over again instead of learning a whole album, right? This is what Sean does. So I'm really excited to welcome him onto the show today to shed some light on the cost segregation strategy for you. Hey, Sean, welcome to the show.
Hi, thank you, Shannon. Appreciate being here.
Of course. Could you just tell everyone who you are and what you do? Introduce yourself.
Yes, so my name is Sean Lichterman, and I'm a cost segregation consultant with a company known by CSSI, stands for Cost Segregation Services.
Perfect. So first of all, what the hell is cost segregation? Because this sounds like a very, complex term. It's like cost segregation. This sounds complicated, financial. He sounds like he's smart, but what do you actually do in kind of, that third grade term?
Yeah, let's dive into it. I think when I bring this term up, whether you've heard this before or you're not familiar with it, it's not a sexy term by all means, right? But when you can reap the benefits and the tax saving side on the back end, you become a believer like myself. You just bought in. So cost segregation, it's a tax strategy for commercial real estate property owners that allows them to accelerate the depreciation on their buildings by reclassifying those assets into shorter recovery periods. It allows them to maximize their tax deductions early on in ownership. So third grade level, what does that mean? I got a building. I reduce a lot of the stuff inside. I save money.
Basically, yeah. But is it only available to commercial property owners?
So it's a wide range of buildings. And it's going to be anything from like an office building, warehouse, pretty much your typical brick and mortar you'll see, as you're driving up and down the road, as well as rentals. So think single family homes, multifamily, Airbnbs, VRBOs. So it's a wide variety of buildings that all constitute for commercial use.
Okay. And then let's just kind of break down the mechanics of it too a little bit. So when we're talking about reducing it or maximizing tax savings, can you just kind of like walk us through how that actually happens? Like how does this actually save money in taxes?
Yeah, and it might be good understanding depreciation as a concept, right? I know when we talk about depreciation, especially when it comes to real estate, you're like, well, why would we talk about depreciation? That's bad. If I buy a car, the moment I drive it off the lot, it depreciates. It's losing value. Why would I want to do that in real estate? Well, in real estate, depreciation is actually a useful tool. It allows you to offset the income you're creating on your real estate. So the default method, which is known as straight line depreciation, you take the purchase price of this building, less land, we can't depreciate land, and you divide that over the course of what a building is set. So if it's a commercial use, it's 39 years. If it's residential use, so think multifamily, single family home rentals, it's 27 and a half years. Now that's going to go on an accruing basis, which basically means I have to own that property for nearly 30 to 40 years to receive my entire tax benefit. Cost segregation flips it on its head. So you're going to get that accelerated depreciation in the early years, allowing, greater tax savings to go purchase more property, renovate your current property, or I tell my clients, take a trip around the world. It's your money, do as you please.
Yeah, exactly. Let's say I have an Airbnb rental. So 27 and a half years for a single family home that I rent out. You're telling me that I don't have to wait 27 and a half years to, let's say I'm depreciating the same amount every year for that term. I don't have to wait that long to realize all of that depreciation.
Correct. Now, for an Airbnb that's actually constituted as a commercial use property, there's going to be a little bit of nuances here and there and caveats. But yeah, so the Airbnb, since it's a transient guests that are coming in and going, it's actually seen as a hotel in the eyes of the IRS.
Got it.
It's actually depreciated on 39 years. But you're correct. Utilize a cost segregation study, whether it's a single family home rental or an Airbnb, and you can accelerate that depreciation to reduce your tax liability early on.
Got it. And so is there anyone who, I guess, is a prime candidate for this strategy? So for those listening who are thinking, can I do this? Let's just go through some examples that you mentioned, the commercial property, right? So you have to own it, right? It's not like you can depreciate a building that you're renting from someone when you're running a business there, right?
Correct. So for leaseholders, so say like a lessee, so someone who maybe purchases or is leasing a Jamba Juice from a commercial strip mall. There's a different caveat. So as long as they put renovations of 200,000 or more, a cost segregation study may help them recoup some of that investment back from their property. But overall, building owners, those are going to have the biggest benefit because they own the building. They're going to have the tax obligation coming up. And this strategy is going to allow them to reduce that tax liability greatly.
Perfect. When do you think it makes sense to look at cost segregation? Like, is this something where, so for example, if someone buys a building or they own a building and they're just finding out about this now from you, Sean, and they're like, wait a minute, I should have been doing this, X number of years ago. Like, do you buy a building and immediately do this? Or is there some type of good time when this kind of makes sense to look at?
Yeah, and then actually, we might spill into a little bit of the eligibility requirements, but I say early on, the better. At the very least, just receive an estimate. I provide non-committal, no-cost estimates just to show you what your tax savings can be. It's always best to review this with myself or other cost segregation consultants, as well as your tax advisor, just to make sure, this makes financial sense for me to reduce my tax savings this year. Because one of the first big pitfalls is if you don't have tax liability to offset, or if you have a lot of losses carried forward from, say, another property, I'm just adding depreciation to your depreciation. It's basically nil. You're not going to receive the entire benefit. So first and foremost, you got to have capital. You got to be making money. You got to be in the business to make money. As long as you have a tax obligation, home run. Yeah, I'd say get your estimate, review what your tax savings are. And also the other great benefit is that it's not a use it or lose it within that year. So let's say my tax obligation to the IRS is $50,000, but my cost savings comes at $100,000. Well, I've wiped out my $50,000 bill to the IRS this year, and whatever I didn't use, I get to now roll forward indefinitely until I use that entire savings up.
That's amazing, right? So now it's basically, I feel like it's almost a card game where you're playing these hands and you're saying, I'm going to play this on this year or play this against this when they have, it's like poker. It's like knowing what their hand is and being able to play the advantageous hand that you have and actually planning on when you're going to play it, right?
Correct. And earlier, the better, right? They say the early worm gets the early bird gets the early worm. I forgot. It's something in second grade. I remember hearing that.
Yeah.
But yeah, basically the earlier, the better, because there's going to be a lot more depreciable assets within that building. Because remember, we're looking at the building and all of its recovery periods. And the earlier I can analyze those, the better and greater my tax savings will be.
Yeah. And so I've heard from a lot of, CPAs and tax advisors that they know about this strategy. They offer this strategy and offer help with it. But, you have an entire business dedicated to this, right? So, a lot of real estate investors, a lot of business owners are taking advantage of this. Can you just kind of unpack for us a little bit why you chose to go all in on cost segregation as your primary model for this business, and like a little bit of how you got into it and why you're passionate about the strategy?
Yeah. Well, first, I love saving. And as much as I love making money, I love saving money. So cost seg just became, a happy marriage. But my background, I come from a pedigree of real estate enthusiasts. My grandfather was actually a city developer within Chicago, and my dad would fix and flip houses. So I've had a lot of firsthand experience within real estate, and then also seeing the tax saving side on the back end and growing up into it. It just makes sense, right? Take advantage of these tax strategies out there. Now, I enjoy what I do so much because I have happy clients. I never get to say, here's some bad news. I'm offering you $100,000 savings to the IRS. You know,
Yeah.
it is never a bad day, and I never have any clients that are upset with me. So yeah, it's a wonderful industry, and I feel like I'm a purveyor of it because it's not really well known, and it's been around for decades. You know, this kind of used to be a segmented thought where it was only for like the Grant Cardones of the world, you know, the high real estate gurus, but hardly not. Individuals who are owning Airbnbs, you know, $400,000, $500,000 a pop, they can qualify and they can also reap the benefit of this tax saving strategy.
Yeah. And I feel that there's a lot of, buzz around why real estate is such a great way to take advantage of tax strategies. This being one of the biggest ones. I think people simply thinking I own real estate is a tax strategy, but you have to execute on these other strategies like a cost segregation, or you have to be hitting real estate professional status, or you have to be doing something that will help drive that forward. Because I think a lot of people think simply owning property is a strategy, but I feel like it just opens up the opportunity for strategies. Do you agree?
100%. It's basically you're just opening the door to what's out there. I mean, there's a number of tax saving strategies. If we look at the tax code itself, there's something like 5,000 or 7,000 pages. About a quarter of that, maybe even less, is saying what you can't do, but majority, so like 75 to maybe 95% of what tax code is saying how you can utilize that tax strategy. So surround yourself with professionals, get into it, and then reap the benefits of it.
Do you have any like examples of client stories or client successes or even big mistakes made where there's a big lesson learned that you can share with our audience today?
Yeah, I've got lots of stories. I'll give you a recent one. You kind of brought up rep status. I think a good one is in the short-term rental strategy. I'm actually working with a couple of physicians who are moving cross-country. So they're high-income earners, and they purchase Airbnbs and VRBOs. Well, little do they know, they actually can qualify for that real estate professional status. And if this is a new term for you, what real estate or reps status allows you to do is double dip on the tax savings. So it allows you to take those tax savings from a cost segregation study and then also apply it to your W-2 income. So there's a number of material participation points to get into it, but once again, I'm not a tax advisor, I'm not a CPA, so make sure you reach out. My little CYA right there. But these individuals, they do qualify for the short-term rental strategy, and it allows them now from their Airbnb that we just performed a $100,000 tax savings credit from their property that they now have been able to apply to the personal income. So one, it made the move far less hectic knowing that they have a $100,000 credit to the IRS in their tax bill. Two, they saved tremendously on their Airbnbs. And three, now they're like, well, so now that we don't have to pay the IRS, a huge amount from our medical professions, let's go renovate the Airbnb and let's maybe look at a different house, maybe on some water. So it was fantastic to be able to help those individuals in that situation.
Yeah. So let's just talk about that for a second, because you said that they can offset basically their W-2 income. And I want to back up for a second and go, that's not typical with rental income, right? So that's an exception. You normally couldn't offset that, right?
Correct. And that's why I like to open this door, the short-term rental strategy, along with cost segregation, because this is for everyday people like you and I. This is for medical professionals, high income earners, tech individuals. You can apply this same strategy to yourselves as long as you go and purchase short-term rentals. That's why it's called the short-term rental strategy. So it's only specific for Airbnbs, VRBOs. And like I said, there's a number of material participation points underneath it that you have to qualify. But yes, it's completely doable and it's approved by the IRS.
I love it. And something you brought up too that was really important is, guys, most of the tax code is how to not pay taxes. There's I want to say it's like 10% or something like that is what's income. And then, 90% what isn't income, or how you can actually take advantage of strategies. I say this all the time that the IRS, actually no, Congress, who wrote it, right? Congress makes the laws. Congress actually created all of this so that we could incentivize certain behaviors. And one of them is owning property. And that's a big, whether it be the home mortgage interest deduction or all these strategies that Sean's talking about, this is part of the incentive. This is what they want you to do. It's actually the encouraged behavior. So it's not cheating the system, right?
Correct. Yeah. And that's kind of why I hate hearing buzzwords like cost seg or this short-term rental is a loophole or it's to circumnavigate the industry. It's not any of that at all. And I think exactly what you touched upon, surround yourself with industry professionals. Don't get all of your information from TikTok, from 20, 30-second clips, because it's not all accurate. Surround yourself with individuals, especially in real estate. You're going to want to surround yourself with specific professionals like tax advisors who do real estate, or CPAs that do real estate. There's a number of CPAs I speak to that never heard of cost segregation, or just are so unfamiliar with it that they too think it's a loophole. That, well, you're going to get audited. You're just asking to get audited. That's not true at all.
Yeah. No, I agree. And you're not asking to get audited. I think, was it Tom Wheelwright, who was on my show, said once, your level of comfort, like as a CPA, is based on your level of experience and your confidence in that you could defend it. It's not actually risky. It's just risky to you because you don't know about it. And that's a big factor too.
100% correct on that. And that actually kind of leads into the different methodologies, or how you can get a cost segregation study done. There are different companies and there are ways to doing it. I like to always follow an error on the side of CYA, cover my own assets. If I'm about to submit a document to the IRS and say, hey, I'm not paying this $50,000 tax bill because of this tax saving strategy I utilize, I better follow all of their guidelines. So in the IRS guidelines, it states specifically to use an engineering-based cost segregation firm or a process, and to also use an unbiased third party. So, there's DIY softwares, there's also accounting based, and there's engineering based, which is what I perform. And more often than not, we actually find a lot of tax savings left on the table because the DIY is not reviewing the actual paperwork. It's not going on site to the properties. And same thing with CPAs. They're more than likely not reviewing, going on the property. And then lastly, are they going to upstand their report? Essentially, if the IRS does, decide to audit that report or that tax savings, are they going to stand by their process? Engineering-based study, my firm, we will.
So you say engineering-based study. Can you just kind of unpack what that means? What does that actually indicate?
So what that indicates is that you have professionals and analysts that are going to go actually on property. And going on property is a big difference between just entering your data into, an online portal and just, reaping the benefits of it.
Got it.
They're actually reviewing the paperwork. They're touching different parts of the building. They're reviewing all the different asset types within. Got it.
So could we walk through maybe, Sean, an example of how to utilize cost segregation in the context of a story? So let's say, let's just use like an office building as an example. You own an office building, but you also operate out of it. Let's say you own the building you work in. What is a one way, or where would you start with a client on a cost segregation study if they came to you with this scenario?
Great question. Yeah. So this is pretty much majority of my day is creating these estimates and then reviewing these estimates and walking them through the process. So first part, I'm going to need initially really just 4 pieces of information to get you an estimate running. And those are going to be, when was the property purchased, as well as when was it placed in service? The purchase price, less land. So remember, we can't depreciate land. So we can typically find this out by just going on the tax assessor's office or communicating with the CPA. Any renovations put into the property, because that actually is going to generate more tax savings for you. And then we can create an estimate right then and there and actually give you a pretty conservative idea of what your tax savings will be. Let's move it forward. Let's say, okay, we like it. We want to do it. It's about a 30 to 45 day process where one of our engineers and analysts will go on property and they'll review the office building. So what they're going to take note are 5, 7, and 15-year asset class items. So when we look at a building, not everything's going to last the entirety of 39 years or over the course of the lifespan of the building, right? Carpeting's not going to last. Windows aren't going to last. Countertops. And the IRS has segmented these into 5, 7, and 15-year categories. So that's exactly what they're looking for. And when they do, well, they tie that all up together. They come up with a nice report. And then based on the percentage of the building, we're going to say, okay, here's your tax savings benefit once we've conducted the report, submit that at the end of the year, and voila. You either offset your taxes completely or you've reduced them great enough where it saved you a ton of money and is creating cash flow.
What's the reporting like for this? Is this something where you have to prove that you did the cost segregation study? Do you have to prove to the IRS that you did this? What's the degree of documentation? How complicated is it?
It'll say it's not complicated enough where, you couldn't understand it, you couldn't get into it, but it is complicated enough to where you need to take specific notes and you want to find a firm that's going to stand by their study. And I think that's one of the biggest pieces, is that you're going to submit this tax savings, and the IRS may review it, they may not, it may trigger an audit, it may not. It's kind of just, it depends. But you want to find a firm that's going to be in your corner and say, no, we said, Sean Lichterman, he's going to get $100,000 tax savings because we found 5% or 35% of the building fell into the 5-year category, 25 in the 15%. And that's why he's eligible for this credit.
Got it. So what are some of the mistakes that people will make that will maybe not make them as successful with the strategy?
Mistakes. It may come down to, there's a couple of scenarios, and that's why it works working with professionals, like working in conjunction with your CPA. In the example of the office building, if you own the building and you're actually renting it to yourself, you can offset your tax liability that way. You're the landlord as well as the lessee. So there's a couple of scenarios where it doesn't make sense, because you have complete control of what your tax liability is going to be, how much income you're going to produce on that. But let's say you purchase the office building and it's from someone else, and they're the landlord. That scenario, we want to find out, okay, do you have taxes to pay this year? Yes, no. If no, then let's maybe wait a year or two when you do. Those are going to really be the biggest pitfalls. Or if you're a flipper. So if you're getting into the property and you're just going to own it for a year or two and you want to flip it, you're going to pay something on the back end known as recapture tax. And that's something at like 25 or more % of what you initially paid. And it's not going to be the most suited, because you're going to be paying high taxes on the exit strategy. But there are ways to also circumvent that by utilizing other exit strategies like 1031 exchange. But let's just say flippers, not really the best choice for, as well as if you don't have any tax liability to offset.
That's a good point. Yeah, like you said, it's like, why play the card, why play the hand and spend the money on the study if it's really not going to make a huge difference in your tax liability?
Correct. And also good to note is that it's retroactive. So even if I owned a building, for 5 years, I can still do a cost seg study. I don't have to have it done within the first year. So sometimes, we'll deal with building owners from 3, 5, sometimes 7 years ago, and we find still enough savings for them to utilize.
And I think you mentioned this before, but I want to reiterate, when you're looking at, if you're a property owner and you want to take advantage of this strategy, what are your tips on who to look for to do it with you, right? Because you mentioned not all CPAs know about this or have experience with real estate. And you mentioned you're not a CPA yourself. I think there's this kind of assumption that in order to do anything, I need to find a CPA. That's what I should be Googling. That's what I should be asking for. Let's just clarify here, what to order or what to be asking for, right, to get this done.
Yeah, and a good way is if you're emerging into the industry of real estate, or you've been in real estate for a while and you're starting to hear okay, I'm hearing there's a lot of tax strategies out there. How do I get involved? I got to say, one is just do the research. Don't rely so heavily on the quick clips. Listen to podcasts and professionals like yourself. You have a lot of great information on here. I've been a long time listener. Grateful to be a first time caller. Remember from the old radio days.
Yeah. Right.
But yes, surround yourself with professionals. And the way you do that, I think at the end of the day, it's just common sense. Ask them what their experience has been. What are their thoughts on it? Ask them examples they work through. That's a good way that I filter out CPAs that are cognizant of cost seg, or they've just never heard of it and they're kind of iffy about it.
Yeah, I think so too. And full disclosure, I don't have much experience with it, right? So there's always a lot of different strategies that some accountants have experience with and specialize in, and some that we don't. And I love that there are certain specialists out there like yourself and like your business, where it's we go all in on a certain strategy. We lather, rinse, repeat, and we know exactly how this is going to go. We just put this song on repeat all the time. We know all the lyrics. We know the whole rhythm. We know how it's going to go.
Exactly. And, lucky for me is that the firm that I represent, they've been around for over 20 years. We've submitted over 40,000 studies to the IRS. We've only had 3 audits come in over that time. And actually all 3 of those were upstanding. So we were able to stand by our clients and say, no, they actually do deserve this tax savings. And the IRS says, okay, good documenting.
Exactly. Oh my God. Yeah. Let's talk about that for a second too. The importance of documentation.
Yes, very important. And I know we were kind of just talking about this offline, how you have some stuff coming up with a client that, documenting, especially when you're doing anything with tax savings, document.
Yes, it can never hurt you to have too much documentation. Whether you share it, different story, but like it can never hurt you to have too much documentation of what it is you're doing and to actually keep track of things. So important. Sean, do you have any other pieces of advice to anyone listening who may be interested in exploring the cost segregation study, where to get started, and how to get in touch with you and your company?
Yeah, so let's kind of put a nice bow on it or wrap it up. We did kind of speak a lot about what it is, the benefit, and go through and walk through a couple of examples here. But really what I'd like to present is the overarching theme of how you can create generational wealth. Now, my adage is purchase, defer, exchange, repeat until you die. And I know, this resonates very well with you. So what does that mean? Well, first, if you're going to get into real estate, purchase property. Work with professionals, brokers, lenders, bankers to find the right property that's going to cash flow or at least appreciate. Once you purchase that property, offset your tax liability through a cost segregation study. Now you're reducing your taxes to bring up cash flow to then purchase more property, renovate, or take a trip around the world. And then the last part in the exchange, have a nice exit strategy where you can defer your capital gains. So that's a 1031. And I'm sure, you've had discussions with that, but that's probably for a later date. But exchange it so you can do this over and over and over again till indefinitely when you pass away. But now you've passed on this portfolio of just wealth in real estate to your heirs, and it's called the step up in basis, so they receive it tax free. That is the key to creating generational wealth, and cost seg is one of those very instrumental strategies in getting you there.
Yeah, and I think that brings up a great point that your tax strategy is bigger than the tactics. It's bigger than the one little thing you can do this year to save money this year. You have to be looking at bigger picture, like he said, generational wealth, and actually, how is this going to impact my future? How is this going to impact generations after me? And how can I be better planning for that future as well, right?
Correct. Exactly right.
So, Sean, thank you so much for hopping on the show today. How can folks find out more about working with you and doing their own cost segregation study?
Yeah, very easily. I'm active on LinkedIn. So it's just Sean Lichterman, first and last name. My cell number is 224-814-3174. Please no spam. Just give me a call if you got questions. I already get enough your car's extended warranty calls.
Oh, and ERC, you getting those too?
Yeah. I get a lot of those as well.
Yep.
But yeah, LinkedIn is easy. And then I can also share my website below in the description if you'd like to have any more questions answered or just reach out about an estimate.
Amazing. Thank you so much. And we'll make sure all those links are in the show notes. Sean, thank you so much for hopping on the show.
Thank you, Shan. It's been a pleasure. Thank you.
Sometimes don't you wish you could just Google or ask ChatGPT what is deductible for your taxes? I wish it were that easy, but the truth is that deducting something can really vary, and it's really hard to get a straight answer for your business in particular, but I made something to help. My free tax deduction guide walks you through hundreds of example tax deductions that can apply to your business, along with a mini training on what actually makes something deductible so you can add more to your list and cater it to your specific industry or type of business. This is all for free, and it's at the link in the show notes. Go check it out. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.